the most interesting thing that I've come across. Most significant thing, I'd say, Colin. So let's go to the next one here just to visualize. So the Atlanta Fed, which is one of the 12 Federal Reserve banks, they have a GDP now, live GDP forecast. And you can go onto their website, you can see what it's basically predicting for the end of the quarter. And what we are seeing really since Thursday of last week is their GDP predictions for Q1 have gone from plus 2.3% all the way down to a negative 2.8. That's
Wow.
more than a 5% swing in the last 48 hours, let's call it 2 business days. So what this is based on is economic data that came out both Friday and again yesterday. The primary driver of this is a weak consumer. So consumer spending is way down. What we're seeing is that the savings that people had accrued through the COVID years with PPP loans and checks they couldn't spend anywhere because of lockdowns, this XX savings is now gone. It's really impacting consumption of goods. The other big underlying data set that's contributing to this negative GDP rating now, this is a recessionary warning, is a lack of investment in housing. So people aren't renovating their homes as much. New builds are down. And obviously we know that real estate sales are down as well, significantly in the past couple of years. But all in all, this is a major red flag. I think recession calls a month ago were virtually zero. And now you've got one of the big Fed banks now predicting that we're pretty much going into a significant and very fast recession. Like, just look at the chart. So, things are really falling off. We'll see if this persists, but I can't imagine things getting better with tariffs, which you've obviously touched on and we'll get into a little bit more. But any thoughts or questions on this chart, Colin?
Well, yeah, I guess my question is, it's such a dramatic shift from a month or two ago. What does the Fed do with this? Not all the Fed locations have come up with this chart, so they're obviously looking at it in different ways.
Yeah.
But having that negative GDP, what tools would be in place for the Fed if other Fed chairs came to the same conclusion? What would they try to do? Because that's a pretty stark.
It is.
GDP.
It is. So I think the biggest thing, Colin, is going to be a change of tone from the Fed chair, so Jay Powell. I think we're going to see him going from a fairly hawkish tone where he's saying, hey, look, inflation's still running high, jobs and employment look pretty good. This was all kind of at the end of December, and he's pretty much removed most of the scheduled rate cuts for this year. We went from like 8 cuts at the beginning of Q3 down to 2? I think now 1 at the end of the year. And so as much as they do still have inflation as a target and they're wanting to bring it down by holding rates higher for longer and trying to be data dependent, I think this new data from the Atlanta Fed is now going to have them going, well, we need to potentially switch gears and be open to rate cuts. I certainly think that the administration has alluded to the fact that they want rate cuts. Mostly what they've been focusing on, Colin, is trying to get the 10-year yield down, which is not something that the Fed controls. So I think one of the things that would actually cause the 10-year yield to come down would be if we have a stock market crash, which we're kind of in right now. We're going to go through that in just a second. So honestly, it wouldn't seem outrageous if Trump early on in his term is actually trying to cause a stock market crash with tariffs, trade wars, and all the other geopolitical stuff that's going on. The stock market
to get the 10-year down.
Get the 10-year down, which they can't control, and then get the Fed to start cutting on top of that. So really interesting. If this is,
but I mean, devil's advocate, why is it more important for the 10-year to go down than the stock market go up?
I think when you look at commercial lending, as far as commercial real estate, mortgages, all commercial debt is really based on the 10-year yield. And we know that the 10-year yield has actually gone up significantly since the September rate cuts started. And so they don't really control the bond market and the yields that are expected based on inflation expectations. And so they really do want to make it cheaper, more affordable, more cost effective for businesses and individuals
Mhm.
to be able to expand their credit and to be able to borrow to buy. And obviously, being able to borrow to buy to offset the reduction in consumption that we're seeing would be a goal as well.
So your hypothesis here is that the stock market pulls back, which brings the 10-year down because there's more demand for the 10-year,
For
which
bonds,
brings the
yep,
price of the 10-year down. So I really want to lay this out for people because
of
I
course.
think when people saw rates cut last September, they thought the 10-year would go down. They thought mortgages would go down. But as you've said, we don't control the 10-year. The Fed doesn't control the 10-year.
Yeah,
The way that we could have that happen, the stock market has a collapse or a big pullback. There's a lot of demand for 10-year treasury bonds because
yep.
they're like, wait a minute, now
We
this
need risk
4.3%
off.
is attractive, right?
Exactly.
We want it. And that brings the price down because there's more buyers. And
Exactly.
now you have a 30-year mortgage. If the 10-year dropped, let's say 100 basis points, then your 10-year mortgage could be at maybe 5% or high fours, which would sort of save the real estate market. Is that sort of
That's exactly it. And the way I like to explain it is the bond price and the yield on the bond is like a seesaw. So if people are buying bonds to de-risk their
sure?
portfolios from a falling stock market, the bond price goes up and the yield comes down. But if people are selling bonds, then the yield goes up. And so they kind of work in tandem, like again, like
Got it.
that seesaw. So if we're going to see a real rotation of capital into risk off, which means money flowing into gold. Of course, we're seeing that happen. But if it means money flowing into bonds, then that would bring the 10-year down and kind of accomplish bringing that down for Trump. Now, it also is early in his new term that he can probably blame whatever economic weakness we're experiencing now on the Biden administration. And actually, I think they're probably largely responsible for a lot of the problems that we're seeing and that we're experiencing. But it's convenient politically for him to see a stock market crash earlier on in his administration
Then
rather than
later.
later, because
Yeah.
he can just kind of absolve himself of any responsibility.
Yeah.